Hello, good evening, everybody. We're just uh, waiting for one more minute to begin. There are other participants who are joining. For the sake of that, we'll start in 1 minute. Please.
Yeah, Naresh, they're good to go.
Yeah. Good evening again. Welcome to ArthSamvaad, your ultimate guide to navigating the world of personal finance. In a year where markets have witnessed volatility and sharp corrections, we are here to help you make sense of it all. Whether you are curious about how the recent economic shifts and the geopolitical changes impact your wallet, or you're looking to build smarter budgeting, saving, and investing habits, this is the place to be. Join us as we break down the latest market trends, share actionable strategies, empower you in taking actions, and bring expert advice to help you to take control of your financial future. So let's dive in. I would like to introduce Mr. Sandeep Bansal, who is the Deputy CIO of ASK Wealth, which is about a quarter century in portfolio management services in India. And Mr. Sandeep Bansal comes with a rich experience of more than 2 decades, about 22 years in precise, with 18 years in equity markets alone. And Sandeep is currently the Deputy CIO. He is a chartered accountant and a company secretary, and also a MBA from IIM Ahmedabad. And Sandeep joined ASK in July 2021. And prior to that, he was heading SBI Life Insurance as equity fund manager and head of their investment research, leading across the asset classes. Sandeep has also worked in the sell side with UBS Securities and Kotak Institutional Equities prior to that. And he was a business consultant at KPMG and also has banking experience with Citibank. So with that little brief, I would welcome Sandeep. And I have a small, I also wanted to set the agenda. So I would request Sandeep to elaborate a bit on the current market happenings and the current outlook he feels his perspectives. And in the meantime, or post his conversation, if you have any queries, you could put it in the chat box so that we would be able to take it up on a one-on-one. Yeah, Sandeep, it's to you for your bit of introduction into the market.
Sure. Thanks, Naresh. Thanks, Team Velocity. And thank you so much, everyone, for giving us time today afternoon. Uh, the markets have seen a lot of volatility in the last 6 months. So, from its highs that were made in 27 this September 24 last year, over the last 6 months, large caps have corrected by around 15%. Mid caps have corrected by around 20% plus, and small caps have corrected by around 25%. 6 months of negative returns have been only seen in markets once before this, and that was about multiple decades ago. Uh, so a lot of the drawdown in the markets, in our view, has already happened. What have been the reasons for the same? Earnings growth in India has been lower than expectations. So at the beginning of the year, the earning growth expectation was more like 15%, while what played out is more like 5%. Secondly, in the relative global context, India was commanding higher than its usual premium valuations, and with a slowdown in earnings, uh, FIIs moved a lot of money out because they thought that they are getting better opportunities elsewhere. Uh, Thirdly, the currency played a big role. So the currency, Indian rupee, has depreciated by around 5.5% over the last 1 year. Out of that, around 3.5% has come in the last 3 months. When the currency suddenly depreciates or depreciates quite a bit in a relatively short period of time, FIIs would like to press the exit button because their returns are dollar denominated. We've seen around 13, $14 billion of FII selling in this calendar year so far already, which compares to around $22 billion of selling which they had done in the whole of calendar year 22. So, this has been very heavy concentrated selling in a matter of a few months. It has also to do with the fact that there has been some kind of US exceptionalism going on, in the sense that US stock markets were forming around 70% of global market cap, while the contribution of US GDP to global GDP is only 30%. The dollar was gaining strength against all currencies globally, including the INR. So money went from India to the US, and money also tactically went to China, because in China, valuations were really suppressed. That was reason number one. Secondly, the Chinese government made a lot of pro-private sector and pro-entrepreneur announcements, which was not the case in the previous 5, 6 years. And then also there were a few measures which were taken to support the private sector. So, there was a tactical allocation which was made to China. Also, with all the uncertainty surrounding the tariffs in the US, the emerging markets, excluding China, except of China, has come down under pressure because the US consumes while the rest of the world, the emerging markets, export to the US. With the threat of tariffs, there were concerns around growth uh, in the emerging market basket. So these, and just one more point on the domestic side, government spending was also weak till actually October last year. Uh, the Q2 GDP print that we saw, 5.6%, was a very weak print, which also created a lot of fear in the FII community. So all these were the reasons. Having said this, were we able to foresee such a ferocious sell down or the drawdown in the markets? The answer to that is no. Markets will surprise on the positive side and on the negative side during various points of time. It'll be very difficult to point out at all points of time as to what is exactly going to happen. But yes, so this was a surprise which came through. Now, as we stand today, how does the situation look? So we believe that there are a number of things which the market in its current sentiments is ignoring. So currently sentiments is weak, liquidity is weak from an FII selling perspective, but fundamentals are actually not that weak. Now, what are we talking about? So if you look at it, the RBI has taken a lot of measures to improve domestic growth. It has infused liquidity in the system, so systemic liquidity has gone up. Rate cut cycle has started. while 25 basis point of rate cut, 0.25% is not a big thing, but it actually starts the cycle and it shows that the peak pain is behind us in terms of interest rates. Thirdly, RBI had tightened a lot of lending norms last year, whether it be for MFI or for NBFCs or for the consumer sector. Now it has started to loosen all of those norms. So all of that is pro growth. So that is one big aspect. The other big aspect which has happened on the domestic side is the budget is pro growth, and we will speak more about it during the Q&A session maybe. So that is also going to help growth. Thirdly, inflation has started to come off. The latest inflation print that we saw was also quite encouraging, and that is because of food inflation coming off. So that is the third positive thing. The fourth positive thing is that rural demand is continuing to pick up. The Rabi crop is also good, and uh, there is slowdown in the urban sector, which was seen in the last quarter. But what we understand from on the ground corporates, etc., is that is unlikely to last for a long period of time, especially with the cut in interest rates, with the falling of inflation, and with the boost provided by the budget as well. Fourthly, if you look at it, the government has also started to accelerate the pedal on spending. So while till October, the government spending on the capital side was down on a YOY basis, in the month of December, capital spending increased by 95% YOY. In the month of January, it has increased by 51% on a year-on-year basis. Obviously, they are catching up on the previous month's lack of spending, but that has also started to happen. Sixthly, what we are also seeing is that the base in India of uh, growth is now benign. So what happened is that with the Q3 GDP growth numbers that have come out are relatively encouraging. And what we believe is that Q4, as per government's own estimates, is going to be 7% plus. And then, we move into FY26, which is also going to be encouraging. So, the trajectory from here onwards is more upwards. Also, if we look at seventhly, the earnings growth of corporate India, the first half of the year, which is the H1 FY25, earnings were disappointing. In Q3, which is the last quarter, earnings have largely met expectations. Were those expectations muted? The answer is yes. Anyways, the expectations weren't high, but at least those muted expectations were met, and we believe that from Q4 onwards, you will see growth coming back. So this is largely on the domestic side. Now let's look at the uh, global macro picture, and then we will take questions. On the global macro picture, is there uncertainty? The answer is yes. There is uncertainty. Global growth perhaps could be lower because of the situation surrounding tariffs. Businesses do not want to invest during periods of uncertainty. That is also true. But having said that, India could be a net beneficiary of this uncertain environment, because other countries are likely to get more impacted by this than India. So that is on the trade side. On the currency side, we've already seen the DXY. The DXY is a measure of the strength in the dollar. If the DXY goes up, the dollar is very strong. If the DXY comes down, the dollar is not as strong. So the DXY was around 109, 110 till some time back, and now it is 103. So basically, the dollar is losing strength. Our sense is that the rupee is also kind of going to stabilize from here onwards. So we are going to see an abatement in the pressure of selling by the FII. So that is also good. And lastly, on valuations, uh, we are currently trading at around 18.5 to 19 times 1 year forward earnings, which is around 5 to 7% lower than our historical 10-year averages. So, from a valuation perspective, also we've become relatively better versus where we were. Uh, in many pockets, valuations have actually become attractive given the fall in the markets. And hence, given the low base of growth and the likelihood of growth coming back of around 15 to 17% next year, with a good valuation correction that we've seen in many stock prices, and the positive measures that have been taken on the macro side, it actually puts up in a good stead to see a good appreciation in corporate profits, which is hopefully will also get reflected in stock prices going forward. This, Naresh, would be our view, and would be good to take any questions now.
Thank you, Sandeep, for the crisp brief about it. Uh, I would like to begin. I have a couple of questions I noted as you spoke. So I
Sure.
would begin with where you ended on the macro part. So, do you think with the changed or the evolving world change in the world order, do you still see India uh, having its foot? I mean, from the all the trade war that has escalated. We earlier had the China plus one as a theme. Do you think it still makes sense for us to look at?
Sure. That's a very fair question to ask, Naresh. So, if you look at it, the top trading partners of the US are China, Canada, Mexico. We are not in the top three. We are not in the top five. We are not in the top seven. We are the 10th largest trading partner of the US, right? Uh, Now, the US will continue to consume. It's not that, it's going to stop consumption. Now it takes around a couple of years to set up a factory in the US to start production, because there'll be 6 months to 1 year of approvals and around 1 to 1.5 years of construction, right? So even if US reshores or brings back to its land a lot of the manufacturing, it will take time. Now, what will happen in those 2 years? It will still continue to consume. So somebody would need to supply to the US. Secondly, the labor costs in the US are minimum 3 to 5 times that of India, right? So, or let's say at least 2 times that of China. So, the point is that manufacturing costs in the US are also going to be very high, right? So, it is unlikely that all of manufacturing shifts back to the US. So, given the cost timelines involved, US will continue to import. Now, if it wants to reduce its reliance on its top trading partners, then, and if it continues to import, it will have to import from somewhere, right? I actually see India to be one of the net beneficiaries of these trade wars. My sense is that we are going to cut a very good trade deal with the US. Our Prime Minister visited the US last month. Our Commerce Minister was there this month. We have already preemptively reduced few duties in the budget. You are going to see increased cooperation between US and Indian corporates. We've already seen signs of that. Uh, from a geopolitical perspective, we are very important currently to the US, right? Because they want us to be a counterweight to China, etc. And hence, I think, we would be China plus one perhaps could get accelerated by this rather than getting impacted. Also, even if reciprocal tariffs come in, see what will happen is that the things that we import from the US are actually not that sensitive, right? So, we would be fine to reduce tariffs there. And I think from a political perspective, from a country perspective, India is likely to be far more accommodative of US requests than some of its other trading partners. So, yes, we will be beneficiaries, and we should continue to look at China plus one, actually, with more rigor.
Okay, that's pretty, uh, I would say, pleasant commentary from you. And just extending that, so do we think when you mention cooperation, do we see more of the Starlink kind of a thing, or would it be much more like how earlier Boeing's and other wanted to be a FDI kind of a partnership?
So, I think FDI is also going to pick up. These kind of partnerships will also happen. You could see duty concessions being given to, specific sectors in India, which is also going to be good because at the end of the day, we need technology for manufacturing. And that technology comes with FDI. Even when China started to manufacture a lot, so India and China were at the same level in 1980s, but from 1980s onwards, Chinese manufacturing started to pick up. China has also received a lot of FDI, including from, in large components from companies in the US. So I think the Indian manufacturing journey has barely started in the last few years. Over the next many years, we will see a lot of FDI coming in, and this will be from US companies. And in addition to that, Naresh, what has also happened is that we have relaxed the requirements or the stringent measures that we were putting on Chinese companies. Because of the Galwan issue and the border disputes, we had put in a lot of restrictions on Chinese companies investing, on Chinese officials working in India, on visas, etc. A few of those things also we've started to now ease because the government has realized that for manufacturing in the country to pick up, you need to learn those practices, adopt those technologies from some other nations. And obviously, countries like US, China, etc., are the ones who are going to help us in this journey. So yes, FDI is going to actually increase significantly. There are going to be technology transfer agreements as well, and many other joint ventures and agreements that will play out over the next many years.
Yeah. So as we move from macro to something you mentioned about policy, I'm now intrigued to know a little bit more about uh, trying to relate. What do you think these sectors or industries that could stand to benefit out of this evolving situation? You have something in mind, your perspectives on that?
Sorry, you asking specific industries?
Industries or sectors,
Sure. So,
what you just mentioned, right? That
yes,
how it benefits is what you see. So, which are all
yes,
those things do you
right,
perceive
sure.
could benefit? Yeah.
So, in terms of industries or sectors that will benefit in our view, manufacturing as a sector will continue to benefit. Uh, People have somehow believe that the tariffs are going to impact Indian manufacturing. So let's break this up and see the various components of it. Manufacturing will benefit because of Atmanirbharta or import substitution. See, currently we are importing a lot of things, and the idea is to manufacture in-house. That itself is going to aid manufacturing. So it is, that part is not about exports, it's about import substitution. Secondly, we are other than the US, we are negotiating a lot of trade agreements with other countries as well, UK, the European Union, etc. So, that is the other aspect which is going to help us. Thirdly, we believe that India will actually be able to manage to strike a good deal with the US, and hence we are going to be net beneficiaries of these trade wars rather than getting impacted by it. So, hence, manufacturing for us remains a good sector. On the back of manufacturing, infrastructure, in our view, is going to continue to be a good sector. We've seen a lot of growth in the previous few years. We will continue to see a lot of growth in the next many years because manufacturing involves movement of goods, and a lot of infrastructure is about like rail, road, airport, etc. is movement of goods and people. So that will continue to benefits. The power sector or energy requirements will continue to improve because of increased manufacturing, because manufacturing is energy intensive, because of, let's say, electric vehicles, improving digital consumption in our lives, with the climates getting more extreme, more warmer at times. The requirements of heating, cooling, etc., keep on going up and down. So all of it, which requires a lot of power. So that's a sector we remain excited about. Discretionary consumption is another sector which we believe will do well, boosted by the tax cuts given in the budget. Uh, so that is the other sector, and healthcare also as a sector we like, because we don't believe that the tariffs are going to impact our pharma exports as much, because it's a relatively essential commodity for the US.
Sorry. Yeah, thank you for that. Just again, from today's one of the news from your organization, from your co-founder, Mr. Sunil. So he was mentioning about ASK strategy on manufacturing and energy, which you kind of also resonated. So I will just move on to one of the queries from the attendees. So from the perspective of the global economy and the current volatile scenario, how do you think the European economy will get impacted?
Sure. See, Europe, what has happened is that Europe was not working as a cohesive union so far. Now, with a common enemy, in a perceived enemy in terms of the new US administration emerging, what has happened is that they've now kind of come together. So, in that sense, from that perspective, it is good for them. Having said that, with the new US regime making it very clear that we are going to not support or provide aid as we used to do previously, it increases the burden on on European economy. So what they will have to do is that they will have to increase their defense expenditure, because perhaps at least for the next 4 years, the situation seems that they are not likely to receive as much aid from the US or security guarantees, etc., which they were hoping to. So to that extent, Europe will have to increase spending on aspects which are maybe not necessarily very productive, but required for safety, security, etc. Thirdly, if hopefully the Russia-Ukraine crisis resolves, it is actually positive for Europe. Why? Because it helps them perhaps over the next few years, not immediately, help resolve some of their energy issues, help resolve some of the refugee problems, helps bring this down uncertainty, resolves supply chain issues and all of that. So from that extent, it is good for Europe. So I would say that, a lot of the growth pains which Europe was seeing in the last few years because of the conflict could perhaps now start to ease. But obviously, they would now need to spend more, and their dependence, and because US is not going to support them as much, they would need to they would need to increasingly take more care of themselves than they were doing previously, which is a negative in some sense.
So in a way, the US administration is doing good for the greater world.
Yeah,
Yeah.
so not in some sense, yes, but in some sense, no. See, what was happening so far is that because the US was willing to participate in all regions of the world, the global economy was very efficient, right? Because one could produce in the lowest cost locations and send it to the most consuming parts of the world. Now with tariffs, more walls are going to get constructed in different regions. So there are going to be more bilateral and multilateral negotiations that would need to be carried out. A lot of the security guarantees of the US will now come off. So, each country would need to increase its defense spending, etc., etc. So, a lot of not necessary productive spending in the globe is going to go up. So, that is not good for global growth in some sense. But then, there will be region specific losers and winners. And we think that perhaps India could be a winner in that.
Okay. So coming to India being on the right side. So how far do you think the consumption can be reignited, or the current budget, how they have given more preference to consumption over capital expenditure to an
Sure,
extent? Yeah,
sure,
relatively capital expenditure. So
sure.
how do you think it can impact and create growth for India?
Right. See, what the government has done is given a benefit of around 1 lakh crore to the middle class in terms of tax cuts. Assuming 20% of that is saved and 80% is spent, around 80,000 crores of consumption boost is going to come to the economy next year. Now, this is going to be a one-time consumption boost in the sense that from FY27 onwards, this is going to come in the base. So there is just going to be incremental growth, right? From there onwards. So does this support consumption? The answer is yes, it does support consumption. And it is and which part of consumption it is going to support? Because this relief has been given to the middle class, which was already consuming all the FMCG staples, requirements, etc., that it was having. This is only going to support discretionary consumption. By discretionary consumption, it could be white goods, it could be some travel, tourism, etc., apparel, and all of that. So, will that receive a boost next year? The answer to that is yes. Now, has the government taken the pedal off the capital expenditure in the economy? The answer to that in our mind is no, and we'll tell you the reasons for that. 3, 4 reasons. Firstly, as per government's own headline budget numbers, capital spending is going up by 10% next year. In FY25, that number is likely to be a 7% growth. So versus 7%, the number is likely to be 10% next year. Now, there are some spending which are classified as revenue expenditure, but they are actually part of capital expenditure. Things like Pradhan Mantri Awas Yojana, etc., the transfer to the states that are made on the capital expenditure account, etc. So if we make those adjustments, the growth on capital spending by the central government is about 17% growth YOY, which is a very good growth. Thirdly, what the budget has also stated is that public-private partnership projects are going to be revived. So if we remember earlier, there used to be these build, operator, transfer projects, which were not there for the last few years because government was awarding projects only on an engineering procurement construction basis, EPC basis. Now the government is saying that PPP is going to be revived. Obviously, frameworks are going to be made over the next 3 to 6 months. So that benefit is going to come only from the second half of the next financial year. But that is also something which is going to support capital spending. Then private sector capex is also going to pick up sometime this year. So if you look at it, utilization levels in the country are around 78% or so. 80% plus onwards is when private sector starts to invest. With the demand picking up, with the cut in the interest rates, I mean, not a very large cut, but whatever it is, at least the peak is behind in terms of interest costs. With a lot of capital raising that has been done in the last few years by corporates, by promoters, by private equities, and the banking sector also being in a good shape, we believe that the private sector, will start to invest. So that is also going to support capital spending. So, we are positive on the capex side of the economy, and we believe that growth is going to continue at very healthy rates over the next many years to come.
Okay, so I'm trying to close this session within the timelines we discussed. So the last two questions. Again, from the participants, with the Canadian Prime Minister showing a positive stance towards relationship with India, what is the export growth outlook for India to Canada, and which sectors are expected to benefit the most?
Sure. So see, in India's export growth to all countries over a period of time is likely to increase. Uh, Especially, we think it's to the US, and it's also going to be to Canada as well. Our primary exports, is actually services, which is IT services. In addition to IT services, what we export is pharma is an important export for us. We export electronics, engineering goods, gems and jewelry, diamonds, that pack, and then also textiles. So these are some of our, primary exports to most North American countries. And yes, we had relatively frosty relations with the previous Prime Minister of Canada, and hopefully relations will improve with the new PM.
Okay. So I'm just clubbing two questions because something else came again.
Sure, please.
Yeah. So first thing is, do you think it's better to wait or deploy the money right now? That is one. And specific to the construction of portfolio, large, mid, and small, and how is this going to play in coming months? Will mid and small caps have no traction, or how do you see that?
Sure.
Yeah.
So see, it's always a good thing to stagger one's investments a bit over a period of time in volatile times, because honestly speaking, even we don't know how the markets are going to react to any specific news flow. And there is a lot of noise in the markets, and emotions are, get flared up in no time. So, it is good to spread out rather than go all at one time. Having said that, we believe that a large part of the pain is behind us. So that spreading out need not be done over a long time frame. It actually needs to be crunched over a relatively a short time frame. As I said, we've seen 6 months of negative returns, which has just happened once or twice before. So maybe could it go on for a few more months? The answer is perhaps yes. But beyond that, then it would require some fundamental crisis to come through, which we are not being able to see as of now. So let's say, while we are believing that these tariff wars might not result in something big, so in case that happens, right, then can there be a fundamental crisis, and because of which pain can continue for a longer period of time? The answer is yes. So uh, to summarize the answer, yes, it is good to stagger, but not on a long time frame, on a relatively crunched time frame. As far as large, mid, small is concerned, see, earlier the strength or the rally in the markets was that everything was doing well, good, bad, ugly, average, great, everything was doing well. I think now the markets are going to be more selective. Good quality businesses, good quality managements, good earnings delivery is going to get rewarded more, and in fact it's going to get disproportionately rewarded in our view. So whether it be large caps, mid caps, or small caps, I think the markets are going to become more selective in nature. So it is not that a good quality small cap business or mid cap business which is delivering on earnings will not do well. We don't have that view just because of the fact that it's mid or small, and that only large caps will do well. Yes, as a basket, large caps are relatively undervalued still compared to mid caps and small caps. But having said that, we believe that there are many pockets in mid and small which, given their growth profile, given the quality, are attractive valued, and those stocks are going to do well going forward.
Okay. And very specific to ASK strategies.
Sure.
Though it is not meant to be, because there are a few couple of questions on that. So I'm just trying to rephrase it. Do we see topping up in the existing strategies? And if so, should it be also staggered in the next very short period of 3-6 months or so?
Yes, so I think it will be a good time to top up. And as I said, maybe in a staggered manner, but not over a longer time frame, in a relatively crunched time frame. Because the reason is that, see, we buy only good quality businesses of good quality managements, good balance sheets, good returns on capital, businesses that have strong competitive advantages. Have the stock prices of those businesses being impacted? The answer is yes, because of the violence that we've seen in markets, because of poor sentiments and poor liquidity due to selling by FIIs. Yes, they have been impacted, but fundamentally things are not, there is no crisis or as bad as, the stock prices are making them look to be. And what happens is that when the markets are in such kind of a mood, there is a lot of collateral damage. It's not that only stock A falls or bad stocks fall, everything starts to fall. So should investors with a longer term time horizon take advantage of these situations? The answer to that, Naresh, is yes.
Okay. So I just wanted to summarize some of the things. You can
Sure.
add if I miss something. So I made some notes. So basically, the sentiment is weak a little also on the liquidity front, but fundamentals still remain strong, and there could be possibility of currency stabilizing. So also influencing the growth earnings to pick up in the coming quarters. And you've given a thumbs up on the capex and consumption-oriented budget, which can also revive growth. And the most important thing is that now is the bottom-up picking stock zone, and people have to take advantage of this market correction to stagger in a very short period of time, and wait for 3 to 5 year horizons to make money. So if that is what I can summarize.
Yes, I think Naresh, thanks a lot for summarizing it really well.
I think one
Okay, okay.
question which is one of the asking about, you touched about manufacturing energy. Do you have a view of AI and IT industries? And a small take on that they're asking.
Sure. So, IT industry, honestly speaking, we've not been big fans of the IT industry. The reason is that we look at two key parameters while investing in a business. One is high quality, the other is high growth. IT is perhaps the highest quality that is out there. So it satisfies that parameter, but it does not satisfy the parameter on growth. Excuse me. So IT is a relatively mature sector with growth profile of around high single digits. So we do have IT exposure in our portfolios, but we would generally be having just about one stock. So, our IT exposure is, less than around 5% in our portfolios, while in the benchmark, the IT is more like 12 to 15%. So, from a growth perspective, we are not very big fans of the IT sector. So, have the valuations become more reasonable? Because we've seen good selling in the IT sector in the last in recent times. But still, because we are not convinced about growth, we are not favorably inclined towards that sector. Yes, the growth concerns on that sector relate to the fact that if the US economy slows down because of tariffs, then the spending by US corporates on IT services is going to come down. Plus, there is this added threat of artificial intelligence, taking away a lot of the business, because a lot of the business is going to get automated. I don't think that a lot of it is going to get automated. Yes, gradually that progress of automation is going to increase, but overall, yes, it is going to be net negative for growth. So hence, that is a sector which we are avoiding.
Suresh, are there any queries pending?
No, all have been answered by Sandeep, and you have been also taken to him.
Okay. So yeah, then I would wind up the session. Once again, thank you all the participants for being on time and asking us the right questions. And Sandeep, thanks for being patient to elaborately, explain each of those queries. We are highly indebted to you, and For the participants, we wanted to inform we would be doing this kind of regular interaction through the industry experts on a monthly basis. And ArthSamvaad, which we have been doing the monthly commentary through emailers, would also include this media going forward. And thanks again, ASK investment team, and also Sandeep and Suresh. Yeah, I would like to wind this session right now.
Thank you so much, Team Velocity, and thank you so much, participants, for your patient hearing. Thanks a lot.
Thank you so
Thank
much.
you.
They're closing the session.